Hello, and welcome to the Weekly Economic Brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, investors started out taking a break from the economic picture to focus on politics, with the first presidential debate taking place on Tuesday night. The event afforded both former President Donald Trump and Vice President Kamala Harris an opportunity to connect with their voting base, although analysts suggest it was a key opportunity for Harris specifically to answer questions on her proposed policies, with details which have largely been excluded from commentary thus far. The debate ran for 90 minutes and covered an array of topics, from taxes to inflation to the broader economy. International events were also a key topic amid ongoing turmoil in the Middle East, as well as a focus on the Biden administration's track record during the pandemic. According to varying polls, Vice President Kamala Harris was the winner of the night's debate, although the race remains extremely tight, with the candidates polling within 3 points of one another. By Wednesday, however, the focus shifted back to the economy, with all eyes on the latest inflation data, with an updated read on both consumer and producer prices, indicating some but minimal further improvement in that reestablished disinflationary trend. Beginning with the consumer side of things, the CPI rose 0.2 in August and 2.5% year over year, as expected, offering welcome reprieve from a more robust 2.9% annual increase in June. Excluding food and energy costs, however, the core CPI rose 0.3 in August, a tenth of a percentage point more than expected, and accelerating from last month's gain of 0.2. Year over year, the core CPI held steady at 3.2% for the second consecutive month, positing no further improvement to speak of. And finally, looking at another iteration of consumer inflation, the supercore, defined as core services excluding housing, the supercore rose 0.3 in August, again continuing the trend of a hotter monthly rise relative to July, and gained 4.5% year over year, accelerating from last month's pace of 4.4%. Turning to producer prices, the PPI rose 0.2 in August, a tenth of a percentage point more than expected, and following a lesser rise of no change the month prior. Year over year, producer prices rose 1.7% in August, down noticeably from the 2.2% annual gain in July, and now marking the smallest annual increase since February. Excluding food and energy, the core PPI rose 0.3 in August, also a tenth of a percentage point more than expected, and following a 0.2% decline in July. Year over year, however, the core PPI increased 2.4% in August. That's a gain from the 2.3% annual increase in July. A hotter than expected read on the PPI, coupled with a hotter read on the core CPI, thanks to a larger increase in shelter and airline fares, underscores the committee's lingering focus on inflation amid a dual, not single, mandate. While continuing a disinflationary trend and supporting the Fed's intentions to broadly open the door to rate cuts this week, the ongoing uncertainty and unevenness in price growth reinforces the need for a slow and tempered approach to policy adjustment as the data continue to evolve. After all, after 3 months of ascent, inflation has largely resumed a disinflationary path, or at the very least has not shown any indications of a reversal in that trend. So, coupled with a top line growth rate of 3% in the second quarter and expectations for the U.S. economy to continue to expand at a faster pace than the Fed's longer run projection of 1.8% in the coming years, there is no sense of urgency or immediacy in the data to quickly adjust from the current stance. As a result, the Fed is less likely to take a more aggressive approach, but rather one of patience as the data continue again to evolve, maintaining a base case of 25 basis point cuts beginning this week, with a consideration but not a commitment to action at every subsequent meeting. In fact, if the Fed did make a more sizable policy adjustment in September, the market would likely misread or misinterpret such action as an intention to rush back to an accommodative stance, as opposed to simply reducing policy firming as price pressures move closer to the target. Heeding that warning of a more cautious approach to unwinding policy firming that's been issued by policymakers, investors have dialed back expectations for a more sizable rate cut this week. However, the market is still anticipating a rate reduction at every meeting in the remaining 4 months of the year, with at least 100 basis points in rate cuts by year end. Also last week, as the Fed presumably gears up for that first round rate cut on Wednesday, the European Central Bank cut interest rates for the second time in 3 months, lowering the deposit rate by 25 basis points to 3.5%. Along with the latest policy adjustment, the ECB also cut its growth forecast for every year through 2026 while maintaining its inflation outlook, with price pressures not expected to retreat to 2% for at least another 2 years. This week, the economic calendar, as expected, is centered on the September FOMC rate decision. On Wednesday, the Fed is widely expected to cut rates 25 basis points to 5.25, marking the first rate cut since March of 2020 after 13 months on the sidelines. In terms of materials for the week, while the September statement is likely to reiterate a data-dependent stance, an updated summary of economic projections, or the SEP, including the famed dot plot, will likely offer a welcomed quantification of the committee's expectations, as well as an opportunity for longer-term yields to reset or reprice higher via investors' expectations for a more expedited sequence of policy firming removal. Previously anticipating one rate cut by year-end, the Fed's expectations for less restrictive policy are unlikely to be materially revised from July, with an upside of an additional 50 basis points, emphasizing again a slow and patient approach to adjustments, despite opening the door for a policy pivot. Aside from the Fed, the broader economic calendar begins today with the Empire Manufacturing Index for September, ahead of a key report for the week, August retail sales on Tuesday. While consumers are still out in the marketplace spending and providing welcome support to the broader economy, the pace of expenditures has slowed markedly as households increasingly feel the pain of higher prices and borrowing costs, particularly as younger and lower income consumers more heavily adjust spending, reducing the amount of nominal dollars spent and reallocating expenditures towards services and away from goods. Last month, retail sales rose 1% in July and increased 2.7% on an annual basis. This was the largest annual gain in 3 months. This month, retail sales are expected to fall 0.2 in August and rise 1.8% year over year, potentially marking a sizable retreat from last month's pace. Also on Tuesday, business inventories, industrial production, and capacity utilization, and the NAHB Housing Market Index. Later in the week, ahead of the Fed on Wednesday, weekly mortgage applications, along with August housing starts and permits. Last month, starts fell nearly 7% in July and 16% over the past 12 months, while building permits fell 4% and 6.3% respectively. This month, starts are expected to rise nearly 6% in August and increase 0.4% year over year, potentially marking the first positive annual gain since January. Permits, on the other hand, are expected to tick up 1.4% in August, but still remain in the red on an annual basis, down over 10%. And wrapping up the week on Thursday, we have weekly jobless claims, the September Philly Fed Index, the August Leading Indicators Index, and August existing home sales. And with that, I'd like to thank you for starting your week with Stifel.